In the early weeks of 2026, a bold prediction began echoing across Wall Street, Washington, and Main Street, a prophecy that promised a dramatic economic comeback for the United States, claiming that America could reach 5% growth, a level not seen in decades, and the message came straight from Donald Trump's economic team. The claim sounded almost unreal, especially after years of inflation pressure, rising interest rates, global conflicts, and fragile consumer confidence. Yet the words traveled fast, igniting debates, headlines, and intense market reactions across the nation. At the center of this storm stood Donald Trump, former President of the United States, now once again shaping economic conversations backed by advisors like Larry Kudlow, Stephen Moore, and a network of business leaders who believed that a new policy direction could unlock explosive growth. They pointed to massive tax reforms, deregulation, energy independence, reshoring of manufacturing, and aggressive trade policies as the foundation of what they called the 2026 economic boom prophecy. For millions of Americans struggling with high prices, mortgage rates, and job insecurity, this promise felt like a lifeline, while for skeptics it sounded dangerously optimistic. To understand the magnitude of this claim, we must travel back to the years following the COVID-19 pandemic, when the U.S. economy was shaken by historic stimulus spending, supply chain disruptions, and the fastest inflation surge in 40 years. By 2022, inflation crossed 9%, forcing the Federal Reserve under Chair Jerome Powell to raise interest rates at the fastest pace since the 1980s, cooling housing, slowing business investment, and rattling financial markets. Through 2023 and 2024, growth stabilized but remained uneven, with technology giants like Apple, Microsoft, Nvidia, and Amazon posting strong profits while small businesses and consumers struggled to keep up with rising costs. By late 2025, the nation stood at a crossroads, balancing hopes of recovery against fears of recession. And it was at this fragile moment that Trump's team unveiled their forecast of a 5% growth surge. They argued that energy production would be the first engine of growth, with expanded drilling, pipeline construction, and liquefied natural gas exports transforming the United States into the world's dominant energy supplier. Companies like ExxonMobil, Chevron, and ConocoPhillips were projected to increase production, creating hundreds of thousands of high-paying jobs and lowering fuel prices across the economy. Lower energy costs, they claimed, would ripple through transportation, manufacturing, agriculture, and retail, reducing inflation and boosting consumer spending. Next came the promise of manufacturing revival, driven by reshoring policies, tariffs on strategic imports, and incentives for domestic production. Firms like Intel, Tesla, General Motors, and Ford were highlighted as key players, expanding factories in states like Ohio, Texas, and Michigan, while attracting billions in private investment. Trump's advisors pointed to the lessons of 2017 to 2019, when tax cuts and deregulation fueled business confidence, unemployment fell to historic lows, and stock markets surged. They believed that restoring similar policies in 2026 could recreate that momentum on an even larger scale. But critics quickly raised alarms, reminding the nation that economic growth is shaped by global forces far beyond domestic policy. China's slowing economy, Europe's energy challenges, geopolitical tensions in the Middle East, and ongoing conflicts in Eastern Europe could easily derail even the most ambitious plans. Financial institutions like Goldman Sachs, JP Chase, and the International Monetary Fund released more cautious forecasts, projecting growth closer to 2%. They warned that high national debt, aging demographics, and structural labor shortages could limit long-term expansion. Still, markets reacted strongly to the promise of growth, with the Dow Jones Industrial Average, S&P 500, and Nasdaq experiencing sharp rallies following policy announcements. Tech stocks surged as investors anticipated increased corporate spending, while energy and industrial sectors gained on expectations of infrastructure expansion. In Silicon Valley, executives from companies like Nvidia, Meta, and Alphabet spoke of renewed optimism, fueled by artificial intelligence, automation, and next-generation manufacturing. They believed that AI alone could add trillions of dollars to the U.S. economy by boosting productivity across healthcare, finance, logistics, and education. Meanwhile, in small towns across America, factory openings and energy projects promised new life, drawing families back and reviving local economies long left behind. Yet the road to 5% growth remained steep, requiring flawless execution, political stability, and global cooperation. Any spike in inflation could force the Federal Reserve to tighten monetary policy again, choking off credit and slowing investment. Trade wars could escalate, disrupting supply chains and raising consumer prices. Labor shortages could intensify as millions of baby boomers retire, shrinking the workforce. And financial markets, always sensitive to uncertainty, could turn volatile at the first sign of trouble. History offered both inspiration and caution. In the 1980s, under Ronald Reagan, tax cuts and deregulation helped ignite a powerful expansion, but also led to soaring deficits. In the late 1990s, under Bill Clinton, Technology innovation and fiscal discipline delivered strong growth, yet ended with a dot-com crash. In the early 2020s, unprecedented stimulus saved the economy from collapse, but fueled inflation that still haunts households. Each boom carried seeds of risk, and each recovery demanded balance, discipline, and adaptability. For everyday Americans, the stakes could not be higher. A true economic boom could mean better jobs, higher wages, affordable housing, lower energy bills, and renewed financial security. It could restore faith in the American dream, allowing families to save, invest, and plan for the future. But a false prophecy could deepen inequality, inflate asset bubbles, and leave working families exposed to another painful downturn. That is why financial literacy becomes essential in times of bold predictions. Diversifying investments, controlling debt, building emergency savings, and focusing on long-term goals remain critical strategies regardless of economic forecasts. History teaches that no boom lasts forever, and no crisis is permanent, making resilience the most valuable asset of all. For investors, disciplined risk management, broad diversification, and patience can protect wealth through volatile cycles. For workers, continuous skill development, adaptability, and financial planning can create stability in uncertain markets. For businesses, innovation, efficiency, and responsible growth can ensure survival and success beyond political cycles. As 2026 unfolds, the nation will watch closely, measuring promises against reality, projections against data, and hope against results. Quarter by quarter, job reports, GDP numbers, inflation data, and corporate earnings will reveal whether this bold prophecy becomes historic truth or cautionary tale. The world will be watching too, as America's economic trajectory influences global markets, currencies, trade flows, and geopolitical power. In every boom, there are winners and losers, and the choices made today will shape outcomes for decades. The true lesson may lie not in chasing spectacular growth, but in building a resilient, inclusive, and sustainable economy that benefits all. Because prosperity is not just about numbers, but about lives, communities, and the future we leave behind. As factories rise, energy flows, and markets surge, the real test will be whether opportunity reaches every corner of the nation. Only then can growth be called success. The 2026 economic boom prophecy now stands before history, daring to be proven right. Will bold policy, innovation, and ambition deliver a new golden era, or will reality rewrite the script? And as America steps into this uncertain chapter, one powerful question remains: will this predicted 5% growth finally fulfill the promise of prosperity for all? Or will it become another lesson in the fragile nature of economic hope?